Okay, yeah. But then quick cloud go. Be like saying on top cloud you go record them.
If you need that, go send it to me.
If you share with them, okay. All right. They see my screen now.
Mm-hmm.
What thing they see for my screen?
Excel.
Okay, maybe Excel now. Normal now wallpaper. Yeah, now wallpaper. Okay, so looking, I think I just worked on one of their stuff. Self.
Are you recording?
I've started it. So
Okay.
start recording. So I think I'm also, in fact, luckily for you, I'm working on one of their financials. I'm doing a projection for their company, Alphabet, Alphabet, Alphabet. Okay, so I'll share the model with you later, Sha.
Okay.
When I still work in progress, I never finish the stuff. Okay, so at least you know how to build a model now, at least on neutral ground.
Mm-hmm.
Okay, so the main thing is how do you get this assumption? So okay, let me do a small presentation to you. And so from the presentation, you'll be able to understand how we get some of the assumption and little or more knowledge on corporate model. Okay, come in. Let me see presentation for these guys. Over to you. Okay, so you can see my screen, right?
Mm-hmm.
All right, I'm starting my presentation. So ask as much question as you would like to ask. So let's talk about structure of income statements. I know you know it, so just the way we understand it when it comes to corporate finance, right? Structure of an analyst and what we call driver-based income statements. Then modeling is all about drivers. So I want to forecast this line item. What would be the basis for forecasting this? And then we have something we call restructuring. So let me just run you through income statements. We believe revenue is like the umbrella of every business, right? And that means irrespective of whatsoever thing you are doing, you need revenue because it's like the umbrella. Once anything happens to your revenue, it affects the business as a whole. And that's why in corporate finance, we can almost set every line item as a driver to our revenue, right? Taking a look at this COVID period, I'm quite sure you also have the understanding of so many companies that had to file for bankruptcy. So revenue is important. Now, as much as revenue is like the umbrella, definitely there are some costs that comes with this revenue, and which kind of brings me to this says that everyone is eating from the revenue. Everyone is eating from the business revenue. As long when you have umbrella, it kind of covers everything. And the first people that eat from this revenue are people that have contributed directly in making or buying your product. So we call them cost of goods sold, direct cost of sales. And we deduct this, we have our gross profits. Now, from revenue down to gross profit is what we call our top line. So I'm quite sure you know already.
Okay.
And this gross profit is now the next umbrella that comes into play. You've gotten your revenue, your cost of sales, which means those are the costs that without incurring those costs, there's no way you make your revenue. So gross profit comes into play. And everyone, what we have left is what covers up this. From the management accounting, they will call this revenue, they will call it variable costs, and they will call this one contribution. So from what is left is what everyone is eating from. And the next people, there are people that are supporting the business, selling general admin expenses, salaries, operational expenses, that comes into play. We deduct that, we have our earnings before interest and tax. Then the next thing that comes into play is our financing costs. So from gross profit downward is what we call our bottom line. Net finance income, EBIT, we pay our tax, we have our profit after tax. So it's more like a proportion to that revenue.
Mm-hmm.
What goes to the dividends, then a retained earning comes into play. As I said, revenue, gross profit, top line, then this one, bottom line item. Now, this does not make sense on its own looking at it. And that's where corporate finance comes into play, because these are what we need to first understand about a business. And this tell a whole lot about a company management as well. Let's analyze with this income statement, which is what we usually do in corporate finance. We usually follow trend. At least for a mature company, we expected to have a consistent trend, and that's how we try to measure how risky your business is. There are a lot of things that can be used to measure how risky business is. Number one is their financials, which also kind of determine their management. Now let's take a look at this. This is Nestle and Indra PLC, and we extracted some of their line item. Now there's something we call operating leverage in finance. I'm quite sure
Okay.
you know operating leverage, right? Do
Yeah.
you have idea?
Mm.
What do you think operating leverage is saying?
In my opinion, operating leverage literally shows us the amount of financial risk involved in the company's operation.
Okay, okay. So I think yeah, you've given me one one complex. So as a modeler, as an analyst, right? You should always learn how to be able to give an explanation in a layman understanding, right? You've given me one complex thing. So now let me show you this first. So revenue, the number one thing is there are a lot of risk associated with you making revenue, and at times some of them you really don't have much control on them. Number one, business are being exposed to different risk every day. And number one, government risk. I'm not sure you have any way you can mitigate government risk, even though there could be some government risk, environmental risk. There was one big company, right? They've established themselves, but they have their own company building. Then I think earthquake happened, and they swallowed up their whole building, collapsed with all their assets, everything inside, and they had to start again. Imagine that kind of risk, right? Economic risk, inflation, time value of money effects, different things that can affect business, right? It's risk. For example, pandemic that happen, yes, it favors some businesses and the rest. Now that now brings me close to what we call operating leverage. In finance, whenever you hear anything like leverage, basically just understand that we are saying what are the one or two things we need to put together so that we can have an optimized result. So we say, oh, what's our financial leverage? They say, oh, mixture of our loan and our equity to be able to have higher return to the owner of the business. So for operating leverage is saying, how well does a company manage the mix of their variable cost and fixed costs to be able to have a good profitability stand? So we are assuming that yes, anything can happen to revenue, but how well does a company adjust themselves? So we have one we call higher operating leverage and the other one lower operating leverage. So there are some industry that are higher operating leverage based, which means they have higher, I think that should be, they have higher variable costs than fixed costs,
Okay.
right? Okay, wait, higher, okay, I think higher, okay, sorry. Higher operating leverage means they have fixed costs more than their variable costs, which means this company, they are fixed cost heavy, more like their operational expenses, SG&A, very heavy. And one example is consulting firm. Most consulting firms usually categorize some of their costs as selling, general, and admin, even though there's this school of thought that is saying no. Those guys, those guys that if they leave the company today, it will affect the business, considering consulting is more like human resource. That's their main asset. There should be a way we can categorize them as assets. If there's no way we can categorize them as assets, we should charge them to the cost of sale. But the whole thing is, under assets, you really don't have control over your human resources. Direct cost, yes, at times, even if there's work or no work, you are still paying those guys. So it's kind of strict to them to that part. Our aerospace as well, right? Our airplane and all this, they are also fixed cost heavy. So now the lower one, which means they are variable cost heavy, and manufacturing comes into play in that aspect. Now there are some companies that are in between, right? So those are things that guide us when we were trying to make assumption about a business, when you want to do a forecast. So revenue, how that's number one thing. As I said, revenue, yes, at times they might not have much control over it. Now, the story now boils down to, okay, irrespective of what happened to revenue, this company, how do they adjust themselves to it? And that kind of give us insight about how well the company is being managed And also going into the future, if something like this will happen again, how do you think this company will manage themselves? So we have revenue, we've taken their gross profits, EBITDA, EBIT, and their profit before tax, and we have their profit after tax. So the whole operating leverage is saying, okay, maybe let's say for 2020, when there was a pandemic, we take this company, what happened to their revenue? Oh, fortunately, their revenue dropped. And we're asking, okay, what's the next thing? Immediately their revenue drop. Normally, variable cost supposed to change with the level of output. So if revenue drop, cost of sales supposed to drop as well. Then we now ask, how well have they been able to manage their selling and general expenses to be able to have a good profitability stand? Okay, what if revenue increased during this period? We ask, what happened during this period that make their revenue to increase significantly like this, right? And we ask, okay, so the fact that revenue increased, their variable costs, did it grow with the same proportion? It's supposed not to be, right? They're supposed to be able to enjoy some opportunity cost and economic of scale and all those things. So how well were they able to manage it? That immediate revenue increased, they increased their gross profit, SG&A also increased, and the profits margin is really not making any difference. So how well they manage that help us determine going into the future, how do you think they'll be able to perform to be able to make a reasonable uh, um, forecast. So this 2016 for Nestle, I just picked those variable, is this to create this shape. Now 2016, look at 2017. This is what happened to them in 2017.
Okay.
Now, so that you understand the story, their revenue between 2015 and 2016 was 20.3. This is the proportion of what they have. This is their profit after tax. Now, we now bring this, we take a look at 2017. Look at what happened in 2017. Revenue increased significantly, 34.2. On the general understanding, as revenue increased, yes, everything's supposed to increase as well. At least they're supposed to still maintain that profitability stand as of 2016. But you can take a look at what happened. Revenue increased. They manage their gross profits very well. EBITDA, fine. And you can see their profit after tax increased significantly, which explain a well-managed company. Don't say revenue increase and you expect everything to increase. No, you're supposed to be able to manage everything and have a good net profit margin. Now for 2017, this is where what we call a consistent trend in a company. This is 2017. Look at the shape. And this is 2018. What can you say about this?
So I noticed that regardless of the fact that the growth in revenue was decreasing, right?
Hmm?
The gross profits profiles were somewhat the same, which means that they are managing their costs well.
Exactly, exactly. So it's not as if so. One thing I want you to also understand is this: the fact that a company revenue growth is lower does not mean
Mm.
there's no increase in the revenue.
Mm-hmm. Yeah, yeah.
So it's always good to be careful when you are making that sentence, right? Oh, yes, company does not grow on a consistent straight line growth method, which means so this year the revenue grew by 25%, another year 35%, year three 45%, year three. So that's really not realistic, right? So you can grow by 10%, then the following year 5%, another year 2%, at least the value is increasing, right? And when the company gets to a mature stage, it's expected that their revenue growth, percent growth will slow down a little bit. So now for 2019, now let's look at 2019 again. The revenue was able to increase by 6.7%. And look at what happened. They still maintain this.
Mm-hmm.
So this kind of tell you a story about this company called Nestle. They are consistent, and which means it makes them less risky, and it is easy for you to forecast it. By the time you build your own model, we expect you to be able to still plug your own figures that you forecasted into this shape. Let's assume everything being equal. If they've been able to maintain this for the past 3 years, they should be able to maintain it going forward. The only thing that will be shaking there will be this revenue. And that's where what now brings us to the second thing, which the research analyst guy, what they do. So if you look at it in 2017, this growth was very significant. The next question is, what happened in 2017? Right? So this is 2016, 20.3, and in 2017, 34.2. The next question, what happened in the economy? What happened in the markets? What happened in the industry? Do you think such thing might continue to happen? Do you think such thing might repeat itself in the future? Right? You've understood that, okay, irrespective of what happened to their revenue, they've been able to still maintain this consistency. So that's why if you see some people building a model and they're saying cost of revenue as a percent to their sales is 50 something percent and they keep it constant, is because they have the understanding that this company, they've been consistent for the past period. So here, 2019, 6.7. Then in 2020, this is just 1.1% growth. Despite this, at least you know what happened in 2020, right?
Yeah.
Pandemic happened, inflation increased, inflation came into its own display. People were restricted indoor, all those funny things. But they still tried, they were able to still manage 1.1% growth. And they still maintain that C. This is 2019 and this is 2020. They still maintain that proportion. So that is saying, going forward, now if you want to make the forecast for this company in 2021, 2021 seems to be more like a new word in the markets, in the industry for some companies, right? They are coming with new products, health-wise supporting products. Those funny things. People are being cautious about their health. Now all these companies too, they are bringing in those funny products, and everything just seems booming. So for 2021, you know that if I want to forecast for Nestle, you must be able to make that, oh, 2020, oh, based on their trend, right? I've taken a look at their trend for the past period. They've been able to maintain this in so period, something like this happened in the economy. They were able to push back, right? They're able to gather, and just that story around that revenue. I say, oh, going in 2021, based on my research, looking at their historical revenue growth and all these things, I expect that their revenue will increase by this so percent. The reality of it is we are just making a forecast. There's nothing like accuracy. And that also boils down into valuation. No valuation is correct. If you model a realistic expected business forecast for any business based on their historical, right? Every company will always be undervalued. Only few. And for example, one of it is Tesla, right? Even this Damodaran had to revalue like 2 times because we were like, this is crazy, right? So those are the kind of things we look at for the income statement. Why do we build model? One of it is to be able to do comparison from business A to business B. And in doing that comparison, EBITDA is one very important metrics. In fact, if you want to do valuation, EBITDA is enough to tell you what the value of a company is, because that EBITDA is more like the true performance. It's more like the true profit from the business. So, and that now brings us to what we call analyst or driver-based structure. For the accountants, the way they build their own financial statement is based on IFRS and standard. And if you take a look at the structure of the income statement I showed to you, I'm quite sure you will see that we did not see EBITDA. There's nothing like depreciation or amortization. Now, analyst and as a modeler, is all about, what we need is insight. And at times, we know that accounting report does not provide that insight. Now, it's not as if account does not want to provide that insight, but because of a lot of funny things, and I'm quite sure, thank God both of us we are accountants. You know how we can argue, how we can twist standards to just fit different things. Just, so just to remove those story, that's why standard IFRS I said, okay, you know what, use this structure. But for we analysts, we want to get more insight, which is our own main objective. What is happening in this business? Why is this? Why is that? So what is the true color of this line? As I said, all the line items require a very clean and clear driver. So let me now show you what we call our analyst structure. Revenue, as I said, is umbrella. Everyone eats from this revenue. And the first people contributed directly, cost of sales, we have our gross profits, which we call our top line. SG&A, we deduct that, then we have our EBITDA. And this is what we call a core business operation. The management accounting makes it very straightforward. They say revenue, variable cost, contribution, fixed costs, and they call this one profit. Now, this is the core profit of the business, core operation. And that's why you can pick your EBITDA, multiply it by your EBITDA multiple, and you are good. Now, for the forecast, right? Okay, let's take it one. So after that, we now have our depreciation and amortization, which is more related to the use of our assets. Now, you see everything below that EBITDA, they are more of management decision. They deals
Mhm.
with management decision. In fact, depreciation, despite standard saying, oh, this asset should be depreciated over 5 years, I'm quite sure we know that there's always a revaluation of assets, right? We say that with this, the fact that Dangote bought an asset worth 1 billion, one accountant now said, oh, based on our standard, we said this your asset will be fully depreciated over 5 years. That does not mean after 5 years, Dangote will take that 5 billion assets and just throw it away. I
Yeah.
think it's only bank people that does that with their car. Right. So now this with us with management decision, and this where what we call at times we have to restructure financials of the accountants, because we are now saying, okay, depreciation and amortization, let's assume I want to compare Nestle and Unilever together, and let's assume Nestle, they are doing their own production in-house, they have their plant and everything, and Unilever, they are outsourcing their own production. Definitely, you know that Nestle we have more depreciation than Unilever.
Mm.
But that does not mean they are not in the same business operation. It is their own management decision to do that. And that should not affect when we want to compare company A and company B. So at times, analysts get this wrong. We know that accountants, at times, we usually put depreciation in our cost of sales, especially for a manufacturing firm.
Yeah.
We also put depreciation in our SG&A. So
Mm.
for an analyst point of view, as I said, all the line item in our model must have a clear driver. So we are saying, but I'm saying my cost of sale is a percent to my revenue. What I'm saying is, I am saying if anything happens to revenue, it will affect all the line item in my cost of sales, just like that trend that we saw of our income statements, right? You see that their revenue decreased, they maintain that margin. So which means
Mm.
that is telling you that they keep driving every line item, every expenses with that revenue clause. Now, if you put depreciation inside your cost of sales, depreciation is already messing up that cost of sales because the driver for depreciation is your PPE, which has nothing to do with revenue. Even if you are not making revenue based on accounting, they'll still be charging that depreciation.
Mm.
So we're not saying for that, what we usually do is we now go to that cost of sale, we go to the note to the account. We remove that element of depreciation from it so that we have the true color of the cost of sales. You know that this line item, they can be driven by revenue. We do the same thing for our SG&A. We go and look at SG&A. We look at all those line items, almost everything can be driven by revenue, except depreciation and amortization, which definitely they are assets and intangible assets. So we remove it. At times we can have impairment, we remove it as well so that we can have the true core operation of the business from revenue down to EBITDA. And it will now make sense when you're saying, oh, going forward, my cost of sales is a percent to my revenue. We are sure that yes, everything in that line item can be driven by revenue. Operational expenses, we go there and we say our SG&A can be set as a percent of our revenue, and we are sure that yes, almost everything can be driven by that. So that's the whole story about when you hear, oh, cost of sales is a percent to revenue, this is a percent to revenue. That's what that is saying. So we have depreciation, right? Then we have our operating profit. Now, the reason why, I'm quite sure you know the reason why uh, EBITDA is really not called operating profit. Do you know?
EBITDA is not called operating profits.
Yes,
Yes.
because remember I was saying this is the core business operation. So if this is the core business operation, I think it's supposed to be called operating profit.
Yes.
What do you think?
I
Do you
think
know what?
difference between EBITDA and what we call operating profits is the fact that EBITDA, in my own opinion, and this is what I say every time, EBITDA is what I call cash profits.
Mhm.
That is what you have actually, you are saying this is what I've offered as a value to customers in terms of sales returns, and this is what I've spent on offering that value, right? And also these are other expenses I've incurred on maybe support staff and so on and so forth. And this is the actual money I've earned from that value I've provided to customers. Right now, we including, so what differentiates that returns from operating profits is the fact that now we are including other expense lines like the assets we used, right? Which is different from what we use to derive the value we give to the customers. Basically, it's just non-cash expenses that differentiates operating profit and EBITDA.
I love that. I love that. You're 100% correct. So the reason why we have EBITDA, just as you mentioned, close to cash, and then operating profit still including depreciation and amortization, despite is a non-cash expenses. We have something we call business cycle, and every business has that business cycle. I usually start with something we call operating assets. You convert your operating assets into revenue, you manage your costs, you have your profit. Then you now convert that profit to cash. Then that cash is expected to be reinvested back into your operating asset. Now, every business has operating assets. For
Mm,
manufacturing company, you see their factory, plant, and equipment. For a bank, you will see their loans and borrowing, because that is what they are using to make more money. You go to oil and gas, you look at their reserve, because it is that reserve that they will convert
mm,
to be able to make revenue. So on that basis, that is why we include depreciation and amortization, and our based on our asset turnover ratio, right, which we try to measure how well are we using our assets to generate more revenue. So that's why depreciation is included before we have operating asset, because we believe this asset is what the business is using to generate more revenue. So it should be included before we have what we call operating profits. Other incomes come into play. At times, accountants usually put under income below gross profit, but to we accountants, we want to see the core business operation. So at times, we usually bring it down. That no, it should
okay.
come under operating profit. I've seen a company where their other income is even higher than their core business operation revenue. So that should not affect our business when we want to do comparison. You can decide to be doing any other activity that you want as a business. Finance income, company A could decide to be um, investing some of their money and be having a lot of finance income, while the other company might not. It is their management decision. Finance cost, company A could decide to be making use of more loans, while the other company decide not to use that. Is their own management decision. So that should not
Okay.
form basis when we want to do comparison. So EBITDA is the clean comparison. Then financing, this related to financing and investments. We have our profit before tax. They pay the government eats their own, and then we have our profits after that. Now, to this we call bottom line, as I said earlier, and here we call management decision. Financial modeling is all about drivers. And whenever you want to build a model, you want to forecast, either for a startup, existing business, the whole question is, what is driving this line item? What is driving this line item? So we take all the line item in our model. As I said, all our line item must have a clean driver. For our revenue, if you want to build for a startup, we use something we call price. How much are you selling this unit? How many units will be sold at this particular period? We multiply that. It's giving us the revenue. You can have a capacity constraint, which means you cannot produce more than your capacity. Demand, for corporate organization where we cannot break things into price and quantity. We usually use what we call growth rate. So year on year growth, so revenue will grow by this, revenue will grow by this, and competition effects as well. You go to your cost of sales. Yes, for a company you cannot break down. You set it up. My cost of sales will be percent to my revenue. If you can break this down, then you have your what is the cost per unit, what is the unit. You factor in some inflation because of time value of money, right? There are some corporate financials that you can also do a work back to be able to get their average price and average quantity. One example is Apple. Apple will give you their total revenue and they will give you their quantity sold. So which means you can do a work back to get their average price per unit, right? And do your forecast. SG&A selling, you ask, but I want to forecast this line item. What can I use as a basic? For a corporate organization, you can set it as a percent to our revenue. If you can break things down, you can go to the cost. Oh, what is your operational expenses, your salary, your monthly expenses? Yes, you factor in inflation, time value of money, competition effect. If the business is expanding, definitely as well. Depreciation, yes, if I want to forecast my depreciation, what can I use as a basis? Definitely our property, plant, and equipment, they must have assets, fixed assets. What's the depreciation rate? What's the depreciation lifespan? Finance cost, you're asking, do they have loan? Do they have overdraft? What is the rate? What is their cash? How well are they investing their cash? Tax, they must have profit before tax. Then they have what we call tax rate. So before we do that, let me show you the other one, which is $5 balance sheet, because most important thing is as long as you can forecast your income statement and balance sheet, cash flow is just telling us what has happened to cash
Mm.
below that. So for the $5 balance sheet, what guide us in making that forecast? If you want to forecast your balance sheet, I hope you are clear with the income statement.
Yes, yes.
Okay. So for the balance sheet, there's something we call $5 balance sheet, and it's what usually guide us. Many people get stuck when it comes to forecasting balance sheet. Most people focus only on income statement because they know that it's the profit they want to see. But no, balance sheet is the king. Balance sheet will explain everything that's happening in a company to you, because everything ends in balance sheet. Remember, balance sheet is a snapshot, and all the values you have in your balance sheet represents ending balance at a particular period. So which means if you lie in your income statement, you can never lie in your cash flow statement, and you can never lie in your balance sheet. That's the truth, because it is a snapshot. It is the first value of your business. So this $5 balance sheet, what we've done is we've categorized our balance sheet into two. You can only have two things in your balance sheet. It's either as an asset or liability. So liability is the same thing as funding, right? So liability, where the money came from, our assets, where the money went to. Now we've categorized our assets into two: fixed assets and current assets. Why the other one? We call liability, which is funding. We've categorized that into three: owner's fund, long-term loans, and current liabilities. And this is what we call $5 balance sheet layers. And remember, it must always equal to each other, right? The next question that comes to play is this. From this, there are a lot of story that you can tell just looking at this $5 balance sheet of any company. Looking at it does not make sense yet, but until we compare it to itself or another company over time. But before we go into that, you need to understand that there's a structure and there's something we call funding match in a balance sheet. And what is
Okay.
funding match saying? It's saying our long source of funding, which is owner's fund and long-term loans. Now, remember that current liability is also a source of funding to a business.
Mm.
You know that?
Yeah.
Okay, yeah. Perfect. So because you want to buy something, you go to your supplier, tell them, oh, please give me this, and I'll pay you so number of this. Now, assuming if they fail to give you, you need to go to maybe your long-term loan or owner's fund to get money to be able to buy it. But as long as they've given you on credit, it means they are funding you currently. So long-term loans, owner's fund is a long source of funds. And based on funding match, it is expected to be funding only fixed assets, which is a long use of fund in our balance sheet. But looking at this now, you can see that there's a funding mismatch already. And
Yeah.
the other one, which is a short-term one, is saying current assets supposed to be funding current liability supposed to be funding current assets equally. Now, looking at this, there's a funding mismatch, which means current is not funding current, long is funding long, and is still funding current, which is not good thing. Now, the gap between that current assets and current current liability and current assets, that gap, what do you think we call it? There's a name for it. The gap between that current asset and current liability. They're supposed to be equal.
Yes. I mean, you analysts will always say that current ratio of 1 is the ideal one to say
Exactly.
direct match
Exactly.
for short-term funds, short-term liabilities. But what's the name?
So
Can
the
you
name
break
of
it
the
down?
name of the gap is what we call working capital.
Working capital. Yeah, okay.
Yes, yes. Now, you've already gone ahead where I'm going already, so that's good. So current assets, current liability is supposed to be funding current assets, which means anytime current liability is not funding current asset, remember both of them, they are more of operating in nature.
Mm.
That gap is what we call working capital. Now, the next question, what's the difference between working capital and operating working capital? Do you have an idea?
No.
Okay, so working capital include everything in our current asset and current liability. So they say, what's our working capital? They say, oh, current assets minus current liabilities, right?
Yes.
Which means every line item in the current asset and every line item in the current liabilities, we put it together, we subtract from each other, give us our working capital. But
Mm.
operating working capital, one thing you should remember is this: operating working capital is just telling us how we've managed our cash.
Mm,
That's
okay.
the whole objective of operating working capital. how we manage our cash. So if you look at our formula, change in current assets, they will tell us, oh, last year minus current year. Change in current liability will be current year minus last year. It's all about we trying to understand how well we've managed our cash. Now, it will not now make sense if you want to calculate cash. You are still now including cash inside the calculation.
Yeah.
So for our current assets, operating working capital exclude any line item that are cash elements.
Okay.
Example, your cash and cash equivalents, your restricted cash will be excluded. Your marketable security, which is more like a cash, will be excluded.
Okay.
Then for the one in the current liability, your overdraft, any line item that are interest bearing, your overdraft will be out. Your short-term borrowings will also be out of it.
Okay.
So when you look at your operating working capital, OWC, you see that you will not have cash there. Marketable security should not be included. Current liability should not be included, and overdraft is not always included. But if we are talking about working capital includes everything.
Oh, yeah. Okay.
Now, it's all about cash, right? But
Mm-hmm.
there are two sides to this when it comes to working capital. Because at times you will look at a company, you do the calculation for a company, you see a company has a positive operating working capital. Another company will have negative operating working capital. The next question is, which one is good? Negative working capital or positive working capital? So I'll be using it interchangeably now that you have the understanding of WC and OWC. Now, there are always two stands to any analysis you are doing. To the management sit on the side of funding, which is current liabilities. Most times our current liabilities are always made up of our trade payables and at times deferred revenue, more like on hand revenue. And they represent more like a free money to a company, to the management. They go to their supplier, tell us, oh, give us this your product based on our company policy. We will take this and we will pay you in so number of days, which means they are enjoying that free money. And by the time they want to pay back, they will still pay them back their actual money. Yes, they might have included some discounts, some other things that being set aside. You can't compare that to an interest of a thing. So management prefers to have current liability higher than their current assets. And that means they are having free money. But on the part of the external, which are more like investors, outsider, they want to say that you have current assets higher than their current liability. And why is to just manage their own risk. They want to be sure that if anything happens to your company today, you can sell all your current assets and use it to settle all your current liability without any stress. And that's one of the reasons uh, 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 suppliers and the owner of the business usually take themselves to court. Because if a company is filing for bankruptcy today, nothing will happen to owner's fund. They will need to sell fixed asset and current asset to be able to settle these other two guys. They
Yeah.
not take themselves to court and say, no, pay me first. No, I should pay me second. You owe me 100 million. I say, oh, sorry, based on what we have. No, definitely there's no company that they will take their fixed asset and current assets, right? That they will sell it and they will still have the same value as what they have in their book value. I'm not sure. At times there could be some exception, but I'm not sure that they will sell all their assets, fixed assets and current assets, and they will still have the same value or more than the book value. So they will now need to manage and say, oh, rank this, rank this, rank that. So that's why. Now the next question is, which stand do I now stay? Which one is good? Management wants to have free money, current liability higher than current assets. And good example is bank. That's why governments usually intervene. CBN, okay, sorry, you're no longer in Nigeria, sorry. So they usually intervene, like telling them, no, adjust this, have this, because what they are using people's money, just free money they are using to run their business. And if you take any bank, you will always see that their owners fund will always be small and current liability will be higher, which means they are using free money. Dangote is one good example. Dangote, in fact, they pay Dangote before you even start production. So you see, current liability will always be higher. right? But investors, outsiders, the supplier that is supplying want to be sure that yes, at least your current assets, there are some things you can liquidate easily and be able to settle them. And that's why our ratio is now saying ratio 1:1. Because the question is, where do I stand? Is it by the management? Is it by the outsider? What will judge where I'm standing from? I say, okay, if that's the case, just use ratio 1:1. But as a modeler, you need to understand this. When you say a company working capital is negative, the next question is, where am I standing? Where am I looking at it from? Is it from the management or from the external? So there are always more than one or two ways to take a look at any analysis, right? So currently now, you know that there's a funding mismatch, which means they will they, they are taking from their long source of fund to be able to fund their operational expense, which is not good. Now let's now analyze this. So when we want to build a model, this is what we usually do. You pick those 5 variables from the company. So let's take a look at Unilever, for example. This is their financial statement for 2015. As I said, a mature company is expected to be consistent over a period. And you've seen that from their profit or loss account of Nestle. Very good example. Now let's take a look at Unilever. This Unilever 2015, what we've done is we've taken their fixed assets, current assets, owner's fund, long-term loan, current liability, those 5 values, and we use it to create this visual. And what we are going to do is we are going to play it over time to be able to see it. There are some companies that their balance sheet shape is always constant, it's consistent. So which means by the time you are building your model, you are done with all your assumption, you should be able to still incorporate that and make sure that your model follows that shape as well. If it's not following that shape, automatically is way off. Now this is 2015, and this is what they had in 2016. Let me show that. 2015 and 2016. The next question is, what happened between 2015? This is their current assets. You can see that Unilever is making use of free money comfortably. In fact, part of their current liability that's supposed to be funding only current assets is also now funding fixed assets. Is it a good thing? Is it a bad thing? What do you think?
My own opinion, right? And just like you mentioned for the banks and Dangote,
Yeah,
right? I don't believe, I mean, it has to do with the core operation of the business, right? Like for the example, a company where you are funded ahead for you to deliver to the customers, having your current liability funding beyond your current assets wouldn't be a bad thing,
I love
right?
that.
So that's what I feel based on the profile of the company and what they actually do.
I love that, right? Which means at times there are some industry that are more like that. And there are still some manufacturing firm which they need to pay the suppliers ahead of
Yes.
time. So which means those money they are paying, they will need to go and get it from somewhere. Maybe if you have time, I'll show you some cash flow analysis as well. And now this is 2016. So now let's take a look at another period. This is 2016, right? And this
Mm.
is 2017. Let me show you again. This is 2016 and this is 2017. The next thing is, what do you think happened? This is such a huge difference from what
Yeah.
we had previously.
Yes. Owner's
Yes.
fund.
Yes, exactly. So as a corporate organization, something like this is not expected. Should never happen,
Okay.
right? You should be able to at least that consistency, even though there's a slight changing. But this one is so obvious. Take a look at what we had 2016. Take a look at 2017. So at times, whenever we see a sudden change like this, the next question is, what happened? We need to take a step further because balance sheet shape is not expected to just be shaking. Any company you pick their balance sheet and their balance sheet shape is not consistent, it tell you that the management is going off. At least a mature company is supposed to be at least consistent, even though there might be some slight changes. So I think in 2017, Unilever they had a takeover and they raise another shares and stuff like that. So I think that's part of what increased their owners fund significantly like that. So those are the things that kind of tell you a story about a company. There are some companies that I think Nestle consistent. You don't need to even waste your time on that, right? Such a huge one. So now let me try and show you a cash flow a cash flow statement as well. Seconds, let me show that. So you can have that understanding as well before I will now jump, before I will show you it's a full case study.
I do ask, those percentage assumptions we use for revenue. What happens in the case of a new company, like a new company that doesn't have historical trends? What do we do in that case?
Yeah, so for that one, what we do is we break things down. You break
Okay.
things down. So as I said, it's all about drivers and components. So you go to ask the revenue. Are you guys generating your so the business is starting today now? Maybe let's have a business case. Let's assume I want to be producing table water and I want to be selling it. I want to be manufacturing and selling it. And I ask you build a model for me. The next question is you just think, what do I need? You need your three financial statements
Mhm.
irrespective of anything, because everything, any further analysis you want to do, they are all picking their variable from these three financial statements, right? You want to do NPV, valuation, free cash flow, IRR, payback period, anything you want to do, they are picking their variable from those three financial statements. So now, set your mind now that you need three financial statements first. But out of the three financial statements, you know that as long as you have two, you can have the other one. So focus on getting your income statement and balance sheet.
Yeah.
You know that cash flow will be the difference of cash. For the
Yeah.
income statement, you now ask, if I want to forecast revenue, what will I use? You now ask them, okay, guys, how will you be generating revenue? Every business has what we call price and quantity. For manufacturing, definitely you know that price, how much are you selling this unit? How many units do you want to sell at this period? For a bank, the way they generate their own revenue, what is their price? Their own price is the interest rates, and their own quantity is the loan they give out, right?
Mm.
For a tech, you're asking, oh, let's say for what's the subscription that they are paying? How many people are subscribing at this period? So you're just asking, what's the component of revenue? What's the price? How will you be generating revenue? You go to their cost of sales and asking, what is the cost attached to you making that revenue? Right? You go to the SG&A, you're asking, what will be your operational expenses? What will be your salary? You ask them salary schedule, how many people will you employ? What will be their salary per month? What will be your normal utility bill? Your subscription, just making provision for that monthly expenses. After SG&A, you go straight to their depreciation. You ask, oh, depreciation, definitely you know that they must have assets in their balance sheet. Then you ask, what will be your assets? To answer that, if you are raising 5 million, you're asking them, that 5 million, what are you going to use the money to do? Oh, we are going to use it to build software. We are going to use it to buy assets, buy this, buy that. Definitely, you now know that, oh, these are from the 5 million, maybe they are buying assets, buying this. What are the line items that can be capitalized and charged as their property, plant, and equipment in their balance sheet? Right? So you go to depreciation and amortization, that we answer that. You go straight to their finance. If they are using loans out of their source of funding, definitely you know that you build their debt schedule, and then you need to calculate the interest expense. Go to the tax. What is the provision for tax? Or corporate tax, the 2% or some 21% of profit before tax. You ask that question. So you usually have this questionnaire to ask those questions. You go to your balance sheet, you are now asking, oh, their assets, non-current assets. Okay, we have this asset, this asset, this asset. You go to the current assets, you're asking if they have inventory. Most time we usually use inventory days. Okay, so you're saying, oh, any stock that you have in your shelf, you should be able to sell it within 30 days or 40 days. So use that. So inventory days divided by days in a year multiplied by your cost of sales. Receivables, you do the same thing. You go to your liabilities, you're asking, are you making use of loan financing? Definitely, you know that they have loans and borrowing. Your equity, the amount they are raising will be assumed to be the share capital if they are raising it through equity or investors. You calculate your retained earnings and you have that balance sheet. So that's how we run that for the startup.
Okay.
So let me borrow this from my company, the brand. So credit to them on this. Something we call cash cycle, and it's also very important. Cash is number one raw material in every business that we do. All right. So as such, cash is king. Cash is king. Okay, comment. Let me close this. All right. So let me just share. So cash is king. And what we've done is this. We've taken Nestle for you to understand their cash. For we accountants, we said we have receivable days, payable days, and inventory days. Then we have our operating working capital. So let's understand how well Nestle is managing their cash. The first thing that comes into play is for them to acquire raw material, right? So let's take one of their products, let's say Chocomilio. For them to produce that Chocomilio, definitely they need to acquire raw materials. And in acquiring the raw material, most times, it's not always an immediate cash transaction. So they go and meet their supplier. Oh, supply us these raw materials based on our company policy. We have a payable days. We pay you in so number of days. So they collect the raw material for free. Then they go ahead. The next thing, they process it, they put it on their shelf, and they take it out to their distributor. Now, from them acquiring the raw material and delivering this to their distributor, it took them 56.7 days. And from them, definitely after they've delivered that to the distributor, let's assume the distributor is also managing cash efficiently at its own end. It will now tell us that, oh, you know what, Nestle, you too, give us this your product, we pay you in so number of days based on our own company policy. So you see that we have two cycle already, and cash is not involved yet, right? So
Yeah.
from there, the next thing is that's what we now call our inventory days. From there, acquiring that raw material, delivering it, taking it out of their own shelf is what we call inventory days. And from there, the next thing is for them to receive cash from their customer. Now, from receiving cash from their customer, we start from the first, which means the first cash to enter this business. From acquiring raw material, no cash. Delivering the product, no cash. And the first thing is we receive money from our customers. So that's why we have that. This says, collect your money as soon as possible from your customer. So now they receive their money 98.2 days, which is when the first cash comes into this cycle. And the next thing is now what? Is to pay the suppliers. Now, look at this margin. Paying the supplier took them 144.8 days, which we call our payable days. You see this gap between receiving cash from customers and paying suppliers, right? It is that shape that we got that story from that our 5 box balance sheet when I was explaining that operating working capital. Now, because they've received cash 98.2 days, the larger that margin between you receiving cash and paying your suppliers, the better for you, because it is more like you using free money. In fact, you can use this to start up another cycle. By the time you still want to pay this guy on 144.8, you are still paying him the actual money, even though he might have added one of his own because of the delay. But you still cannot compare that. Right? This is Nestle. Now let's compare this to Unilever. Now it took Unilever 63 days to deliver their product. And look at the time it took them to receive money from their customer. Do you think this is efficient enough?
They receive after 106 days.
Exactly.
Abi?
Yes. And
Then they paid in, wow. The other one is better.
so now imagine they are receiving money from customer 156 days, whereas Nestle, they've already completed their own cycle.
Cycle, yes.
And now looking at this operating working capital, based on your understanding, do you think this is good or not? Let's assume you are at the management end.
The operating working capital,
Yes, it's negative. Do you think it's good?
if I recollect what you have said about operating capital, is when we are comparing current assets with current liabilities after taking off all the cash elements.
Yes, exactly.
So it looks like they're having a negative operations.
Yes, so this is what I'm saying. So based on our normal operating working capital formula, it's saying current assets minus current liabilities, right? So if your current asset is higher than your current liability, it will give us positive.
Yeah.
which is what the one-sided that we're being taught in school. But as I said, from the perspective of the management, if your current liability is higher than your current asset, it means you have free money you are using. So by the time you compute that formula, it will give you a negative operating working capital. So which means Nestle, they have sufficient fund to run their business,
Okay.
right? Because this is payables. See this guy, payables of 144.8 days.
Okay.
And they collected their own cash 98.2 days. And you can see this margin, which means they
Mm-hmm.
are using this money. In fact, they could deposit this in one of these our 30 days government stuff and
Mm-hmm.
earn some interest back from it. And still be able to pay this guy back. So this negative cash means they have excess money. Their current liability is greater than their current assets. So management has free money. But for this of Unilever, it means they are short of what? They are short of free money, which means this 2.9 billion that is positive, they need to go and get it from somewhere, which will definitely be funded by their long-term funding,
Oh, okay. Okay. I get what you're saying.
right?
Mm.
So they receive money 156.9 days, whereas Nestle, they've completed their own cycle and they are still paying this guy 194.5 days. If you're a supplier, who will you prefer to supply your products? Definitely
Ah,
you prefer Nestle.
let's leave
All right,
it.
exactly. So now this is Unilever. Now let's take a look at another one. This is Unilever. Let's now compare Unilever to another one. This is Unilever and this is PZ.
Ah.
Exactly. So PZ, imagine the time it took them to be able to get their stock out of their store.
This is the longest.
169.5. And secondly,
Right.
they have to go
Wow.
and pay supplier before they even receive cash. So
Almost 6 months.
so which means this supplier they are paying, someone is funding it. They are short of that cash. And you can see the operating working capital is positive. So
Mm.
these are the things we draw out before we jump into building any model for us to have this full understanding. Now to the model part. So whenever I want to start a model, so hopefully this is also alphabet. So Google everything. We first take a look at their every company usually have these 5 years. Okay, my Excel is acting funny. Come, let me close it and open it again. So every company usually have these 5 years historical in their financials.
Mm.
And that's the first thing you need to first to do. You can use it to analyze, understand what is happening in the company. They've been a great company, right? And I think their the acquisition or merger that they did then also has really been very, very helpful. As you can see, 20 over the last 5 years, they've been having a very positive increasing growth, which is very, very
Very-
excellent, right?
Yes, yes, yes.
And also their net profit margin, they've been able to increase, they've been able to maintain that range as well. 22.5, 21.2, and 2020, 22.1, which is a
Mm.
very good one. All right, so you just take a look at it for you to understand. This is their balance sheet shape. So it's always good to create this as well.
Mm.
And this also tell a story. So current assets, you can see they've been able to maintain their current assets to be within this range,
Mm.
58, 55, 54. Their
50.
non-current assets, they've been able to maintain that as 41, 44, 45. So which means going forward, you should be able to maintain your own forecast within this percent range as well. So it's not as if by the time you are building your home, you are now saying their current assets will be 75%, right? And
Mm-hmm.
you're now saying their non-current assets will be 25%. So definitely, someone saying this, you know that your model is messed up already, because mature companies are expected to have a trend, right? Even if you are still saying 65, 35, this is still not good because your model is going out of the company consistent shape. So by the time you are doing your own, done your own forecast, you should be able to measure it against this trend to be able to understand that. At times there could be some changes, and that's why you need to go and ask what happened during this period. Current liabilities, you can see that non-current liabilities margin. and their equity percent as well. You just try to see and understand that shape as well. And every other line item in the balance sheet, you can measure them against their the total assets. For
Mm.
example, what I've done here is I'm just trying to see how well have they been using their loans in their funding. So I divided the current their loans, right? Where's the loans? Where's the loans? 135. So this is their loan. I just measure it against their financing. What's percentage of their long term to their financing, so that I'll be able to understand that structure. And I can see that 2018, their loans to their total funding. So the total assets is still the same thing as total funding. 1.7, 2019, they maintained that same thing. But 2020, maybe because of pandemic that happened, they had to get some extra funding, right, to be able to push things up, which you can see here, that has effect on their revenue, and they're able to also increase their cash and marketable securities. They kind of correlate with that story. So after that, the next thing is you extract your income statement. You extract it here, which is what I've done here. And you can see this. This represent the historical period. So after you've gotten this, I have to do some restructuring to be able to get this depreciation amortization, so that I have a very clean and clear stuff here. I can share this with you as well. You also extract your balance sheet historical. So most time cash flow, you really don't need the historical. So after that, you now go to your income statement. You go to your inputs. This is where you now start dealing with those assumptions. So before you can do that, number one is you need to now identify the driver for each of those line items, right? They said, oh, if I want to forecast my revenue, what can I use as a basis? I said, oh, okay, let's use that. Can we break revenue down? If you can break revenue down, you just go straight to the note to the account, right? So let's take a look at this. Let's scroll down so we can see that. We'll take a look at their revenue breakdown. If it's something they give in their annual reports. So I think overseas they usually give their own breakdown, not like Nigeria, like country. So you see it here. So they will
Mm.
give you. So Google search and order,
Mm.
YouTube ads, Google network, Google advertising. So they will give you the breakdown of their revenue.
It's need down to join Google Cloud.
Yeah, so Google Cloud, other bets, Edging gains. So they'll give you the breakdown of how they've been able to get that revenue. And that's what you can see here. So because it's very difficult for you to be able to forecast. So after you've gotten that, right, you now need to go ahead and use it. So for example, I was saying our revenue will be year-on-year growth,
Mm.
right? So revenue will grow by this, will grow by this. So what we usually do is you now use that to do the historical calculation. You need to get that. So I'm saying revenue will be year-on-year. So I'll type my equal to go straight to their historical. I'm saying current year divided by previous year minus one, so that I'm able to get the historical trend.
Uh-huh.
Right. So after this, so if it's a company that has a consistent revenue growth,
Mm-hmm.
we can use the average of the last years. So that's one of the reasons why at times you can have historical years of 5 years. Some people even go back as 10 years. The whole thing is going back as 10 years does not make sense. Right. At least a mature company, the last 2 years should be enough as a basis. The truth is, the historical, the past really does not depict what the future will hold. I'm quite sure 2019, when most of us were doing a forecast, nobody expected what happened in 2020. But at least we're just trying to use a basic to be able to picture that. So you can decide if it's a company that has a consistent growth, you can see that it's between this range, this range. You can use the average. But if you see, for example, now this is 23.4, this is 18.3, this is 12.8. Definitely using this average really does not make sense, because it's going to give us something around 18.2,
Mm-hmm.
right? So what we usually do is this. At times, you might need to take a step further, read more on what the research equity guys have. listen to investors call, right? Or you go to their company website to download their Outlook.
Sorry, Victor, please hold on, please.
Okay, okay.
Um, I think this is a call from California. Hello, fine. Oh, okay. Can I call you back? I mean, I'll call you back. Yeah, yeah. Sorry, Victor, I thought it was Google because that head office is California. I didn't know it was
Oh, okay.
campus at California. Let's continue.
So you can go ahead and check the companies under their investors relations to read about their outlook or investors call to be able to have some idea regarding what's up, or uh, check the market research analyst reports on the company and what's expected. So that can guide in getting this, so that you'll be able to have this the other way, because definitely there's no company that will grow on a consistent percent. So when you see some people model and you see they can just pick the average and just keep the average constant for the forecast period, that's not realistic. You need to take a step further. What do you think will happen in 2021? 2022 to come, what do you think? 2023, what do you think? 2024, what do you think? So you'll be able to get that from those informations, investors call, their company outlook, some investors, some equity research reporter as well, to be able to have idea regarding that. Also, Excel can also help in getting this forecast. So there's a formula we use in Excel. So let me delete this. All right. And what's the formula? We call it forecast. So this is more like you doing statistic stuff. So we call it forecast linear. All right. And it asks you for your known X. It asks you for your X, which is the current. Okay. Okay. Can you hear me?
Mm-hmm.
Okay.
Mm-hmm.
So it's going to ask for the X, which is our period, comma,
Okay.
what is our known Y's? So this is our known Y's, the values, comma, and what is our known X, which is our last period. So I can close the bracket and press enter. So you see, Excel will automatically look at the trend from these three guys and give you this. To understand that, so Excel can help you to make those forecasts as well. So let me just.
Okay. How accurate would that be?
Uh, the one thing about this is at times Excel might need you might need to have lot of historical value so that it will be able to look at those trends. We usually use it more when it comes to data analysis, whereas you have a very good maybe you have your sales data for January to December 2016, January to December 2017, and you want to forecast, so you have enough data for it to look at the trend of your sales and be able to just give you something from there.
Oh, okay. Oh, okay.
Mm.
So 3, 5 years.
So three, you have 5 years. 5 years is still good. So they look at the
Okay.
trend. But at times, if you look at it and you see that this is not making sense, you
Mhm.
can delete it. But just for you to have idea, as I
Oh,
said,
okay.
the best way is more for you to go through those investors call, listen to the reports on the company itself and all those things to be able to have idea and ask, oh, in the economy going forward, what do you think happen? Well, maybe you, and also read their directors' reports. So maybe next 2 years, especially that one is common to oil and gas. To say, oh, in the next 2 years, we expect to invest more in our reserves so that we'll be able to increase our reserve base and be able to increase our revenue. And also that just kind of give you more like insight that, okay, based on the plan for them to invest heavily on this. So maybe their technology, they are trying to improve, and just be able to tell that story.
Mm.
Okay, because of this, we expect this, so that will definitely have impact in increasing their revenue. They've decided to increase their marketing, create more awareness. They are starting up a new product, and I think, for example, now Apple. So at least every year, I think they usually do it every 2 years. I think they are changing it now. They always release new products. So at least for that quarter, which they release new products, their revenue is always on point. So those are kind of things that you also keep in shape. So this other source of revenue, you just set it as a percent to their total revenue. So what has this Google search, what has been the percent contribution to the total revenue, which is what we have here. You see that, you check that to be able to see, is there a consistent trend there? YouTube ads, what is the contribution in this period, in this period, in this period? And I think you can just use the average to be able to get this. They still look, they have a trend as well. So the cost of revenue, that has been set as percent to revenue. So you do the calculation for the historical, all right? And you sure we have this SG&A. So 2020 looks like a very funny year. And based on our valuation thing, well, we have this concept which says when you're trying to understand a company and you want to do a forecast, don't use the don't use their financials in which the economic is really affected. Don't use that because you are expected to see different variation, right? So it's always expected. So if you take a look at this, look at their cost of sales percent in 2018, 43.5. I'm quite sure if you look at the past year, you see some things. 2019, 44.4. So that's a range, a very good range. But 2016, look at what happened. Now 2020, so there was pandemic, so it's expected for funny things to happen. Look at their Google Cloud. So Google Cloud 2018, 4.3. 2019, 5.5. That's a good trend. But 2020, look at what happened. Just went up. So because something happened in the economy and it has that effect. Look at their provision for tax, 12%, 13%, then in 2020, just went up like that. So that those kind of things just kind of affect that decision. So stock-based compensation, 6.8, 2018, 6.9. So you need to identify the driver and then now you need to do your historical calculation and that kind of give you trend. There are some that can still be that be kept constant, right? Where some you can use average, you can take, so you use average, some you can decide to use the minimum. So if you are using the minimum percent of their historical trend, that means you are saying you want to be very, very conservative, right?
Okay.
So you can decide to use, so we have more like 6 methods. So the first one is you use the average. So
Okay.
you and that's one of the reasons why some people usually go as far back as 5 years, right? So that they'll be able to get that average, right? So the first one, they can use average. So that's for a company that has a consistent trend. You know that taking a look at their historical, so you identify the driver, use it to do the calculation for the historical, and that kind of give you idea. For example, look at this, the accounts payable as a percent of their cost of sales. In 2018, 7.4, in 2019, 7.7, and in 2016, slight decrease, right? Let's assume 2020 was 4. So something like this, you can decide to use the average because at
Mhm.
least there's a consistent trend in that line item. So deferred revenue, you can see 1.4, 1.6. So deferred revenue divided by their revenue to be able to see the historical trend. 1.4 in 2019 and 1.7 in 2020. This is a consistent trend. So using the average, two could be fine, or decide to use the minimum, the maximum as well. So balance sheet, you are also allowed to use the last historical, the last historical percent, right? So for
Mm.
example, this is my operating lease. I said operating lease as a percent to their total funding, 3.5, and I kept it constant for that period. So you can use those methods interchangeably, right, on different line item. So last historical, some they use the minimum percent of the historical. That means they are trying to be very conservative. There are some that they use the maximum. That is very, very aggressive. Call that one aggressive method. So you can take a look at their revenue and say 23.4, and they use that 23.4 for the forecast period, right? Which is very, very, so that's more like aggressive method. So the other one is what we call we call it running average, right? What does that mean? So let me delete this. So running average is this. You come here, you type equal to average of these last 2 years. Can even use 3 years. Enter. You come here, to copy it to the right. So to take the next 2 years, you come here,
Begin the
drag it.
average. Okay.
So
Mm.
that's what we call run here. So you come here, you put it like this. You come here, you put it like this, and you see to give you um some great numbers for running average. So you can use that as well. So how many is that? One, two, three, four.
Ah,
1, 2, 3, 4, 5. So the last one is what we now call level two. Level two way of making assumptions. So that level two yes, look at the historical, you understand the historical. Then you're now saying going forward, which is more like the work of research analysts, right? Normally, if you are building a model, you're not supposed to be the only one working on a model, and it's supposed not to even be your work to get all this assumption. It's someone that's supposed to research analyst supposed to work on the assumption, do the research, look into the industry, and be able to feed you all this. But at times, as a corporate modeler, you are also uh, you are you're a research analyst as well. So you need to understand it. So the ways they do it in see, someone would have gone ahead to do the historical research and everything. They read the outlook and be able to just give you some of those assumptions, be able to do that. But at times you need to be the one to do that. So level two, you go what's happening in the industry, what has been the industry compound annual growth rates going forward, what do you think their revenue will be, what do you think will affect this, what do you think will affect that. So you are telling the whole story and saying, oh yes, in 2021 I believe 10.9. Asking you on what basis, why do you think is that? Okay, looking at the historical trend, this and this, then this, then this, despite the pandemic that happened in 2020, they've been able to push 12.8%. Now, I'm not saying the revenue will not grow beyond this, and that's why I have to create a scenario around this. I'm just saying, okay, let me be conservative. Let's even assume they'll be able to still meet up the same percent increase, continue considering what's happening in the economy. Everything is just bouncing back, and we hope they should be able to push back to higher percents where they are coming from. So you just have a whole lot of story. Oh, the industry current compound annual growth rate is this, which means this percent that I've supplied here is still lower than the industry percent, the compound annual growth rate, the industry percent is saying this. Based on this research, guys, they said the expected outlook for this business should be this and that and that. So it's just all about that story to be able to just make sense, right? So use that.
yes.
So you at least you get the driver. This line item, what we drive it. This line item, what we drive it. If I want to forecast it, what can I use as a basis for forecasting this, right? So I
Yeah.
also maybe I should just try and share this with you now so that you can have a copy of this and you can run through this. Then I will show you. I think I also have another company. Um, so you can run through it, and I'm quite sure that everything there is what you know. So I've just given you the basic of it all.
Okay. Thanks.
So let me look for another company that I can share. So let me drop that for you in the chat box. Which other company now? Let me see. I think I worked on Apple not quite long. Okay, yes. Okay, so this one is for Apple for this model. So when you open this model, do you know do you have idea what we call iteration in Excel? Iteration.
Iteration.
Yes.
No.
Okay, so uh when we build your model, especially corporate model, we usually have this guy. You can see this sign here.
Yeah.
Yeah, so it's telling you that so is what we call it circular reference, where a formula is referring to itself. So we usually have that one whenever we are calculating our interest income and at times interest expense. So our corporate organization, they are not expected to leave cash idle. Cash is not, it does not come easily. So when they have that cash, the cash they have in the business, we always expect them to save that money, right? So what does that mean? So if you look at this cash flow, so this, let me go down. So we're saying, you see this cash that they have here, this cash or some of this cash of this 6.2 that they have here, we assume this cash, uh, this is ending cash. So we assume that at times they usually deposit some of their money, especially what they close. If they close with this ending cash, definitely they're not going to leave this cash idle. It's either they invest it in something or somewhere to be able to generate interest income for the current period. So, so because this cash is an inflow, is a result from what we've done here in our income statement, right? Yeah, before we get that, you definitely know that we must get our interest income. So this interest income that we have here has already been included before we get this net income, before we get our cash. So now it is that same cash element that we will now take again and now use it to do the calculation for our interest income. So that's what usually gives rise to that circularity. So most time when you have that circularity and they send a model to you, you need to go to your file, go to your options, and you have it under formulas, and you click this enable iteration calculations so that Excel is aware that, okay, yes, you are doing it intentionally. But it's always good to always remember to switch it off, because you can be working on your Excel and you do some error, some mistake that are not intentional. So if this guy is on, it will just automatically allow the error to work. That's very dangerous. It's one finance guy was relieved because of this. He forgot to switch off the enable
Wow.
iteration. So one of the error that this can allow is this. Let me come here. Let's assume I have 200 here. I have 500 and I have 300. If I sum it together here, it's supposed to give me 1,000.
Yeah.
Now look at what this circularity can do. So if I copy it, let me put it here, and I come here. Remember, this is the cell that's supposed to contain the results. So look here. I
Yeah.
sum L6 to L8.
Mm-hmm.
Now if I come here and I type equal to sum L6 to okay, O6 to the cell that contain the results. That's it. I'm supposed to highlight from O. So let me do that. Equal to sum. I'm supposed to highlight from this 200 to 300, which is more
Mm-hmm.
like O6 to O8.
Mm-hmm.
Now I'm now adding O6 to O9, which is the cell that contain the results. And I
Mm-hmm.
close the bracket and I press enter. Now, normally supposed to show me dash or give me error.
Oh, yeah.
Mhm. Now, if I go to my file and I click on this options, formulas, and I click this, enable iterative calculation. Now look at what happened. I click OK. Look at what happened. It gives me 100,000.
Yeah.
Now, if I press F9 on my keyboard, look at what happened. The value will keep increasing.
Ah.
Exactly. So that was the mistake the guy made.
Ah.
It was not intentional. So they submitted the model. In fact, they've released the font. So it was when the IT guy was trying to consolidate the model with another model that they now saw the error. So it's as good as I have 100K here. I have 100, I have 200, and I have 500. Now I come to this cell, I type equal to the cell that contains this 100 plus the cell that contains this 200 plus the cell that contains this 500. I have this, right? So let me switch it off back. So I have this 100, 200, 500, and I have 800 here, right? So now
Yeah.
look at this. Let's now assume I want to come to this. Well, let me see. This is. Let me type 10% here, right? So I'm saying this 10% will be 10% of this our 800 that we have here. That's more like 80.
Yeah.
Now, let's assume I'm now coming back to this cell that contain 100, and I type equal to 100 plus this my 80. So remember, this 100 has been included before I got this result of 80.
Yeah.
So if I press enter now, look at what happened. So it's telling me that this 100 in this cell has been included before I got this result of 80. And now look at what happened again. I'm now adding the output. I want to go and add it back to what has given rise to this. So Excel is going to give me this. So if I go ahead and I switch on that iteration, Excel will allow it to work. See, it's going to work,
Oh, okay. Oh, okay. Okay.
right? So let me switch that off.
Ah, iteration. No, ni debe.
Yeah,
No idea.
it's always good. It's always good to know because most times when we build corporate model, we usually have this. So, and this is the whole story. So now look at this. You see this interest income?
Uh,
Okay, so interest and dividend income. Okay, let me even use this. I have it here. So I've included it before I have this my profits before tax, right? And
okay.
from there, I took it straight to my cash flow statements
Mm-hmm.
as my okay. Thank you. They are the back. They are the back. So you see it's been added back to my cash flow statement here, right? To now
Yeah.
make up my what? To make up my total ending cash, which I have for this period.
Mm-hmm.
So this ending cash was now taken straight into our balance sheet as our ending cash. This cash now is now what was taken back into my calculations to get my interest income, to get this guy.
Okay.
Okay, no, I think he's I'm going. Where is this? Okay, yes. So to now get this my interest income, which you can see here.
Okay.
So we usually use the average of last year closing cash and this year closing cash. So that one is just to adjust for timing. So we are not sure some of this cash, maybe they deposited it at the beginning of the period, some at the end of the period, some during the period. So just to adjust for that timing differences. So that's why we usually use the average of last year ending balance, this year ending balance multiplied by the rate. So that's the whole thing that usually gives rise to that circularity. So this is for Apple. So Apple follow the same thing. You extract your historical financials, although this one I just did for 3 years. Okay, 3 years as well, right? After you've done that, you go straight to your input. You identify the driver for each line item. So as I said, they will give you their own revenue and the breakdown as well. So this one, how do you think their revenue will grow year on year? So iPhone products, they said most times they usually have these 2 years of a thing. You can see their revenue for iPhone has been decreasing, but Mac, iPad has been growing. Their wearables, home and accessories, they have a good revenue for growth there as well. Their service, they maintain the consistent growth over the last 2 years, and this is their cost of sales margin, which you can see that it is consistent. Their service also more like consistent as well. The operating expenses, you can see that more like a lot of consistency. Selling general as a percent of the net sales, they've kept on this good margin. That can form a basic for forecasting. So you can run through this as well. Maybe I should just share it with you so that you understand, especially the financing. This one has financing, this one has valuation, and also some scenario. So you can take a look at that analysis. Then I think I built a DCF inside it as well. Terminal value and valuation, EBITDA multiple as well. So should I share this with you as well?
I beg go share it, share it. Tomorrow morning is the interview.
Nothing in the panel. Okay.
Not so much.
We go, go run ourselves. So is there any other thing you would like to ask?
Wow, this has been highly detailed. I mean, as you're as you're discussing and walking me through it, I was typing for some I want to keep on my tab because I was
Okay.
advised to have a split screen for the
Oh,
informations I would necessarily not have at the back of my mind that I would need them to complete my thought process. So some of the things you mentioned that I know that I wouldn't want to look into my notes for. Right. I typed them in my notepad, which are the things I'll just put on my screen when I'm asked questions related to modeling. Why the other things I feel I just need to read them through again, right? To have a detailed understanding. I know that I don't understand it, so I have to have a detailed and information at the back of my mind so I can use it effectively. But at the end of the day, is to be able to communicate that thing in the simplest form for the people to understand. Because I'm meeting senior managers and business partners,
don't
and
worry, Charlie. Them, their own life is not hard. It's not like
mm,
Nigerian interview. You are good,
I
mama. I'm
have
not worry.
3 interviews tomorrow, back to back.
I'm not worry. Don't
Well,
coast don't clear.
I mean,
Coast
so
don't.
Victor, thanks so much, Amo. This one you have
Uh,
given me is very so detailed that I feel is enough ammunition for me, like they used to say, to fire the
no,
gun.
no, well,
I
it's
appreciate
garage.
it.
So just remember to share the recording with me now.
Yeah, I will.
Okay, great. Yeah.
Yeah, I will.
All right now. Say good morning. Then you want be good night. Say,
Good afternoon, you.
good afternoon.
Good afternoon.
No,
So,
no,
thank you. I appreciate it.
all right now. Be good.
Yes, I'll play recording.
All right. Okay. Thanks. Man. All right. Yeah.
Yeah.